So yes, today's session, master class on mutual funds, basics to smart investing is all what we're going to cover. Quick disclaimer before we get started, right? We at Pennywise are financial educators. In no manner are we advising or suggesting or asking you to buy or selling you any sort of products. Just like teachers in the school used to teach you things, teach you subjects. Similarly, we call ourselves, a part of the Pennywise School of Personal Finance. What we are building is a school of personal finance, and all we want to do is teach you, give you the right tools, give you the right means, give you the right understanding, so tomorrow you can take the right decisions whenever it comes to your personal finances, right? That's the aim, that's the intention with which we will run the session today. During the course of the session, once again, we might take the examples of a couple of mutual funds, companies, so on and so forth, but in no manner are we affiliated to any one of them, right? Just wanted to make sure all of us do understand that before we get started with the session. Cool. Okay, now I know all of you, some of you who joined in previously have filled in the pre-workshop questionnaire, but for those of you who haven't, can you quickly do that? And you know what? We will look at these responses right in this session today, right itself, right? So I'll give you 2 minutes to quickly take out your phones. And Gautam, if you can also put in the QR in the meanwhile, sorry, in the this link in the chat or the QR in the chat. And those of you who haven't filled it, if you can quickly take out your mobile phones and fill it, it's just going to be 3, 4 very quick, multiple choice questions. So it should not take you more than 15, 20 seconds to answer that. Okay, let's start looking at the responses. In the meanwhile, people are filling it up. And then I'll increase this. I hope this should be visible to all. Before investing, do you think about how long you want to stay invested? Well, 73% of you say yes, always. Very good, very good. About 18% sometimes, about 7% hardly ever. And I'm so glad that nobody has selected the last option. Well done. Very, very happy to see that number. When comparing two mutual funds, which factor among the below should you look at first? 1 year, 3 year performance is what 50% of you say. About 25% say category benchmark, 17% say star ratings, and just about I think 7-8%, yeah, 7% stay fund manager. Okay, this could be the QR, sure. This could be a little different than what we had assumed. Here you go. The QR is on your screen once again. And also Gautam has uploaded the QR file, right? So in case anybody wants, you can just click on that and then quickly scan it. Okay, moving on. How do you see the relationship between risk and return? And 72% of you said higher the risk, higher the potential return, right? Every time this question comes up, I always remember that scam 1992. Kya wo, risk hai to ishq hai. Right? Yes, I am sure all of you also thought about the same. What would you do if 1 lakh rupees falls to 94,000 rupees? Most 95%, 90% of you said review my investments and act accordingly. Wonderful. And I think we've received a lot of questions as well. Don't worry, we will make sure all of these questions get answered during the course of this session. And whatever is not answered, we will stay for as long as possible and make sure all your questions are answered. Okay. In fact, the way we want to actually do this session today is not really go through what slides or what PPTs we've kind of made for you, but actually do it the way you want us to do, right? So we will go ahead and start asking you a lot of questions, and we'd love it if all of you could be super interactive. If you could, put in what sort of challenges do you have today with mutual funds, and then we will start answering those. And while we answer those, we will, cover whatever content we have to cover. Now, one thing that I forgot to tell you. I am a late riser. Okay. And this Mr. Ankit, he has moved his this session from 3:30 to 11:30 in the morning. So I did not have my breakfast. Okay. Now the only way that I can be fully energetic throughout the session is when you guys give me that energy. Right. So I would love it if all of you could tell me how excited are you. I just see thumbs up emojis. I want more excitement emojis. And along with that, if you can put in some sort of food smileys so that at least those smileys can fill in my tummy. So I would love it, right? What do you think I should have for breakfast? Show that to me with the help of some smileys. Arey, subah subah if I have cupcakes, I'm gone. Revan says cake hi kha lo. Wow, Xavier is giving me some healthy breakfast. Praful as well. Rohisha as well. Shraddha is giving me some omelets. Wow, wow, that's going to be too much for me. I think we all need to get in a room to have so much of food. Love it, folks. Love it. But I hope you get the vibe of this session. This is what we're going to keep doing for the next 90 minutes, not 60 minutes. I know the invite you got was till 12:30, but the way we've planned this session, it should go up to about 90 minutes. So in case you have some meetings, try and see if you can push them around. Although we'll try to cover most of our content till 12:30, but still it will be really, really nice if you can stay along till 1 because we've really, really planned a lot of things for you, right? And this is all that we've planned during the course of this session today. We will start with understanding some of your current issues, some of your current questions. We will go ahead and show you an example, a real returns of a mutual fund over the last 25, 30 years. We'll talk something that we are really passionate about, which is Mission 1CR, which we've actively been speaking about in our sessions. I see a lot of beer mugs. Come on, guys. It's Friday morning, not Saturday morning. You can't have that today. Tomorrow, pakka. Right? Okay. Yes. So where was I? I was at the Mission 1CR. Then we will cover types of mutual funds, terms you must know, something about active and passive investing that not a lot of us kind of pay attention to, but I think it's very important for this crowd to know. How do we check whether our current investments are a pass or a fail? The next and the most important one, I think, in the current circumstances all across, one common question: should I buy the dip? How should I buy the dip? What should I do with the war? The stock markets haven't been performing. What should I go ahead and do? And then how do we analyze funds? And at the end, we will also show you a way in which you can leverage AI in order to do the mutual fund screening for you. Cool? Excited? Let's get started then. Wonderful, wonderful. I am super excited. Cool, cool, cool. And now, before we just go ahead and do that, I wanted to quickly share who am I. And I don't have a lot of slides here, or I don't have. I don't want to put it in a very fancy way. But as Ankit gave a really nice introduction, I don't think I deserve even half of that. But there's one thing that I want all of you to know, which is I come from a engineering background. I come from a non-finance background. I learned money myself by looking at a lot of videos, by reading a lot of blogs, and by also, by God's grace, I had some of the right people with me, some of the right friends, some of the right mentors who could give me that guidance in order to take care of my finances. I started my career back in 2014, working with Accenture and then a couple of companies. I did have the opportunity to go to US and Mexico for a couple of years, and that actually did give me some additional active income that helped me with my savings and investments. But fast forward 12 years, I was able to take the plunge last year to quit my job and pursue my passion full time with Pennywise, right? Now, the reason that I'm telling you this is not to boost, not to tell you how great I am or whatever extra things that I've done. Not at all. I don't feel any of that. But all that I'm trying to tell you here is if I can, so can you, right? All of us at the back of our mind have some or the other passion that we want to pursue. For a lot of us, it could be the current job that we are doing, and I'm so happy and so proud for all of you. But for me, it wasn't the case. I did not want to do the job that I was doing throughout my life, and therefore I was able to figure out things, invest with a discipline, and actually create a corpus for myself that I could sustain on my savings for the next few years. I'm not saying that I'm done for life. I'm not saying that I don't need any money in life. Not at all. Don't get me wrong. But what I'm saying is, whatever investment savings I could do over the last 10, 12 years have given me enough cushion to pursue my passion for the next couple of years, right? That's the reason why I wanted to tell you a little about myself. and want you all to keep it at the back of your mind that it's not tough, it's simple, it's easy. All we need is discipline, all we need is some studies, and we can all do what we all want to do. Okay. Shriram, I will answer that, but I will answer that in some time. Fire number, I have a little difference of opinion when it comes to fire number and so on and so forth. And so I would not say that I have achieved my fire number, but what, as I said, just a few minutes up before as well, what I have achieved is I've been able to achieve a cushion for myself that I can try and pursue whatever I want to for the next couple of years at least for the next 2 years. I can say that I'm not actively working for money, or I'm not actively dependent. I have some savings that I'm able to use for the next 2 years at least, right? So that's the best that I can kind of answer your question. Okay, now as I said, we want to do this with a lot of questions, and so before we go ahead with that, what we wanted to understand, Viraj, I just shared the ultimate objective of this session is today when you go back, you have enough understanding of what to do with mutual funds, how can you create your entire corpus with mutual funds, how to select mutual funds, so on and so forth, right? So anything and everything that you have questions about mutual funds, that's the point we are going to be discussing today. Cool. Okay. Now, quickly tell me in the chat. And I think some of you are responding to hosts and panelists, so you can just click on it and change it to everyone. But what's stopping you from investing today? A, B, C, D. I've already started investing. I know now the concepts. I'm still not convinced with the idea. I still feel overwhelmed. Okay. Majority of you have said I have started investing. Okay. Now there's one more question for all of you who've invested. For all of you who invested, who started investing. Okay. Om, got your answer. Now for all of you who's mentioned A, although you've started investing, do you understand mutual funds fully? Can you scan through your entire portfolio and tell me which mutual fund serves what purpose? Why did I invest here? What kind of investments, what kind of stocks or uh, uh, debt funds is it further investing into? Okay. Majority of you saying no. Understood. Got it. That's the feeling that I wanted to get. And I hope this session now gives you that understanding that you will be. Okay. I see a lot of questions on ULIPs and things. We will cover that. Don't worry. But before we get started, so we've already gotten started, but before we move on to sharing more information, let's do this quick case study. Okay. Let's do this quick case study, which is Nandita has been investing in a large cap mutual fund scheme for the past 6 years to fund her car purchase, which will cost her about 18 lakhs and 54,000 on road at current price. Okay. Due to market volatility, you've seen what's happening these days in the market. Current market value of her investments is down by 9%. Sriharshini, I will just answer that large cap thing. Don't worry about it. For those of you who understand this, here's the question. What mistake do you think she would have made? And currently, what do you suggest her? Anyone? Anyone who can type the answer in the chat, or if somebody wants to come up, you can raise your hand and we'll try and see if we can bring in one person to answer that. You could just comment that I would like to speak. You could just put it in the chat and we'll try and bring you on stage so you can actually speak. So Deepika says she should have kept checking the market volatility every now and then instead of waiting till she reached this stage. I think it's incomplete. Instead of waiting till she reached the stage, maybe what you wanted to say is take a car loan and keep invested till the market rise. Okay. But with respect to mutual funds, what's the mistake she made? She must invest in small and mid cap too. Okay. As a test engineer team production. Okay. She should have aimed for 5 years, transfer the money into FD last 1 year. Absolutely, Nishant. That was the answer I was looking for. Well done. Exactly, you got the point, right? She started investing in it 6 years before. She knew she had to buy a car in 2026. Now tell me, when she started investing, it was a long-term goal. It was a 6-year goal. But in 2025, was it a long-term goal anymore? No, it was a short-term goal, right? And so instead of waiting till the very last moment, what should she have done? She would have started withdrawing some of her investments from her equity investment schemes and put them into her fixed deposit, liquid funds, or debt-oriented schemes. Make sense? Right? Okay. Now, next question. Be honest. How many here didn't even understand the question? Be honest, folks. Be honest. I'll be honest. The first time when I learned about mutual funds, I did not understand anything. Excellent. Excellent. And thank you for being so honest. Thank you for being so honest, because that's what we're going to cover in the next few slides. Okay? That's what we're going to cover. Wonderful. Wonderful. Okay. Don't worry. Don't worry. Don't worry at all. Don't worry at all. I just kept that case study there just so that I could get this exact feeling as to where all we stand and how, what kind of content should I be covering, so that all of you have some sort of a takeaway from the session today. Okay. Now, before we begin telling you what mutual funds really are, we wanted to show you another example of long-term wealth creation. Very important. Okay, listen to this very, very, very carefully. But here is a very serious example of an actual mutual fund return over the years. Okay, I hope you can see the screen. I will see if I can reduce this and increase this. Okay. Now I hope you can see the table on the left side and the graphs on the right. Okay, perfect. Now, there is this mutual fund which started investing in the year 1996. Okay, there is this mutual fund scheme started in 1996. In 1996, let's say I invested 10,000 rupees. Okay, then in 1996, by December itself, I lost about 50 rupees. Okay, maybe some market downturn happened and I lost 50 rupees. 10,000 and losing 50 rupees at that time was a lot, right? But let's say I continued staying invested and I continued invested for the next few years. And this same scheme, which I invested 10,000, went up all the way to about 21,000 rupees by 2000, right? And then what happened? For those of you who remember, there was this dot-com bubble in 2001, 2002, where markets had crashed. And so what went up to all the way to 21,000 started coming down, coming down to almost 11,000 rupees in 2001, right? Forget NAV. I'll cover all of that. But you just look at the date and you look at this final amount. Okay. NAV is the price of one unit of mutual fund. Just like every stock has some price, right? Think of it as mutual fund ka 1 unit ka price. Okay. Now, where I was, so 28th September to 2001, this dropped down to 11,000, about 12,000 rupees. Okay. Now, some of you panicked, some of the people panicked and they withdrew their savings. For those of us who did not panic, it went all the way up, 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 up over the next many, many years until 2007, it went up to 1,70,000 rupees. That same 10,000 rupees, we did not invest a single penny more, just that same 10,000 rupees. So that went up to 1,70,000 rupees. And once again, in 2007, 2008, if you remember, there was a global financial crisis, the Lehman Brothers and all of that happened. And again, once again, the stock markets crashed. And so 1,70,000 came down all the way to 92,000, right? Once again, few people withdrew their savings, few people continued staying invested, and once again it went all the way up to almost 7 lakhs, 8 lakhs. Okay, before that, before COVID, 2019, all of us remember the COVID downturn, COVID impact. What went up till 5 lakh rupees in 2019 December came down all the way to just 3 lakh and 46,000 rupees. Once again, the COVID crash happened. You remember the COVID crash, right? And so many of us stayed invested during the COVID times as well. And all of this money till 27th Feb, that 10,000 rupees became 11 lakh and 63,000 rupees. That 10,000 rupees remained 11 lakh and 63,000 rupees. Now, what am I trying to tell you here? What I'm trying to tell you here is these small graphs that you see, the crashes look so bad, just, all of a sudden down. But now, if I plot the same graph over a 25-year period, if I plot this same graph over a 25-year period, can you see there is the 2000, 2001? It's a straight line. I no longer even see a dip. 2007, 8, okay, thoda sa dip. Then it went up and up and up. To 2020, a little dip, went up and up and up. And now in the current market scenarios, maybe a little dip, but hopefully once again, up and up and up. The point that I'm trying to make here is that all of these things will continue to happen and have continued happening in the past. The short-term events, the wars, the economic changes, the global changes, something or the other will keep happening in the world, right? It's a big world. There are many, many people. So something or the other will keep happening around the world. But what data has consistently told us is if we continue staying invested for the long term, we don't have to worry about these short-term events. And that, my friends, is the power of compounding, is the power of mutual funds, is the power of any investing, right? That's why I wanted to start this session with sharing an example that could actually help you all understand the power of investing in mutual funds over a long period of time. Srinivas, again, no affiliations, but I believe that was some HDFC related fund. Yeah, maybe we'll just check and let you know. We purposely did XXXX so that you guys don't go and put all your money in that fund. Okay, right? So does this concept of compounding take care of inflation factor? Varun, not at all. Inflation is completely separate, right? Inflation is something which is not even in our hands. Inflation will continue to grow. Inflation will continue to rise, right? But irrespective of that, it is very, very important for us to save and invest. And that's what we wanted to kind of cover. Okay. Now, we've done few mutual fund sessions for Ethica and partners in the previous times. What are the rolling returns here to get the exact picture? Yogesh, this was the rolling return. This is what I was telling you about the rolling return. If you're looking for the exact number, we'll share that with you shortly. Gautam, if you can just put that in the chat, the rolling return actually that's come out to be. Yeah. Okay. Now, let's move on. I know we've lots to cover. Terms you must know. Now, what I was saying is we've done some mutual fund sessions in the previous times. I'll request Ankit if we can put those links in the, the YouTube link in the chat so you can have some information there. So therefore, I will not go into too much depth of making you understand all of that. A lot of this content is also available on our YouTube channel. So you can just go there and look at it and, kind of understand the very, very basics. But I will still cover what you all need to know and what's the kind of feeling that I've received from the session here, right? So the first and foremost thing, I hope everyone understands mutual funds, right? What is mutual fund? Mutual fund is simply all of us pooling our money together, giving it to an expert, and the expert investing that money into various schemes on behalf of us, right? Since we don't have an understanding, since today, if we have to invest in direct stocks or direct equity, we need a lot of research, we need to do a lot of studies. But since we may or may not be able to do that with our full-time jobs, mutual funds come in very handy when we actually give our money to a mutual fund company, which is also called an AMC, an asset management company. And the person in charge there would kind of, gather funds from everyone and invest them into the respective schemes and stocks and so on and so forth, right? So that's the basic understanding of mutual fund. Some of the common terms that you must know: fund manager. Fund manager is the person in charge of running that mutual fund scheme, right? They are not the agent or the advisor who's selling you the scheme, but actually an employee, the head of a certain mutual fund company that comes from the right, skill set, has the right education and takes care of how to invest your money, right? So that's fund manager. AMC is the asset management company. NAV is, so let's say if we divide mutual funds into units. So today, if we invest into mutual funds, we're investing, say, 5,000 rupees, 10,000 rupees, right? Of SIP. But what are we getting out of that 5,000, 10,000 rupees? So what I was saying is today we have a lot of, yeah, so today we might be investing 5,000, 10,000 rupees of money into mutual funds, right? But now what does that mean? So 5,000 rupees or 10,000 rupees of mutual fund that we are investing will help us get a certain amount of units, right? So just like if today, if a stock is 10 rupees in price and we put 100 rupees, so we get 10 rupees of stock, we get 10 numbers of those stocks, right? Similarly, the mutual funds are also, in order to help us get the allocation, they're also divided into multiple units, right? And the price of one unit is called an NAV, or a net asset value. Cool. Expense ratio is something, kind of a charge that the mutual fund company or the mutual fund takes from us to give us the benefits. Exit load, lock-in period. Again, these are certain terms that come into picture when we are withdrawing our money from there, right? You can just take a screenshot of this or maybe take a note of this. And these are very simple self-learning terms which you will be able to understand. Now, moving on to the most important thing, types of mutual funds. And this is where I've seen a lot of people make mistakes actively. And therefore, let me cover what types of mutual funds are, right? So, on a very high level, we can say the mutual funds can be divided into three parts: equity oriented mutual funds, debt mutual funds, and hybrid mutual funds. Let's understand what each of them means. Equity oriented mutual funds. Now, understand this concept called market capitalization. Market capitalization, what market capitalization means is, so if today, let's say, if today Pennywise, you want to ask what is the worth of Pennywise, okay, for example. So let's say there are total 100 shares of Pennywise and the price of each share is 10 rupees, right? So the worth of Pennywise becomes 10,000 rupees. Sorry, 110,000 rupees, right? Total number of shares into price of each share. That gives the market capitalization. So if today you go and check, let's say Reliance ka market capitalization, Infosys ka capitalization, TCS, or any of the companies that are listed out there, what you will find is the total number of shares into price of each share will give you the market capitalization of that company. Now, what happens is the experts of our stock market, they calculate the market capitalization of all the companies that are listed on the stock market. And let's say they are sorted from a top to bottom, like from in a descending order of market capitalization, so that the company with the highest market capitalization sits on top, and then it keeps coming down and down and down. Okay, simple. So market capitalization calculated for all and every company, sorted in the descending order. Company with the highest market capitalization sits on top and then keeps coming down as the market capitalization drops. Now, the top 100 companies from this list, the top 100 companies from this list are nothing but called as large cap companies. The top 100 companies from this list are called large cap companies. The next 150 companies are called mid cap companies. 250 first and onwards are called small cap companies. Now, what are equity mutual funds? Any mutual fund that invests into stock market is predominantly called an equity mutual fund. So now any mutual fund that is investing our money into the top 100 companies, all or any of them is called a large cap mutual fund. From 101 to 250 is called a mid cap mutual fund. And from 250 first and onwards is called a small cap mutual fund. As simple as that, right? These funds are then further diversified into multi-cap. So, for example, if there is a mutual fund that says, okay, we want to invest in large, mid, and small, all three schemes, they are called as multi-cap mutual funds. Similarly, flexi-cap are also the same. In multi-cap, minimum of 25% has to be invested in each. In flexi-cap, it can be dynamically invested across large, mid, and small, right? And then you have the large and mid cap, in which there are minimum 35% in large, minimum 35% in mid, right? And then you have a certain ELSS, which is an equity linked saving scheme, specifically used for people who are, who want to invest into mutual funds with respect to the tax saving under Section 80C in the old regime, right? Clear? So that's overall how equity mutual funds are, are kind of structured. Make sense? Yes? Acha, also, folks, I know there are a lot of things coming up on the chat, but I'll also suggest you all to use the Q&A section. So you can put your questions there so that it's easier for us to make sure all the questions are answered. Because, again, the questions might get lost in the chat. Now, coming to debt. What is debt? So just like today, we will have a lot of options to invest into fixed deposits, into corporate bonds, government bonds. We don't know where to invest in, right? Which FD to invest in, which corporate bond to invest in, so on and so forth. So a debt fund is a fund that actually takes our money and diversifies it across various funds, government bonds, so on and so forth, right? No equity exposure, all fixed income schemes exposure, right? Now, on your right side, what you see is the maturity period. What does maturity period mean? Maturity period once again means so today when we invest into a fixed deposit, when we say we have done a 1 year fixed deposit, what we are really saying is that 1 year is the maturity period, right? So after 1 year, we will get our money back, and therefore that 1 year becomes the maturity period, right? So a debt mutual fund, so different fixed deposits and different bonds will have different sort of maturity times. So any mutual fund that invests into government bonds or securities, or sorry, government bonds or fixed deposits with the maturity period of 1 to 3 months is called a liquid fund. 3 to 6 months is ultra short fund. 6 to 12 months is low duration fund, and so on and so forth, right? So debt funds predominantly are investing our money into government bonds and fixed deposits. And then finally comes our hybrid schemes, right? As the name suggests, hybrid, a mixture of both equity and debt. And so these hybrids are also planned in such a way that a conservative hybrid scheme will diversify our money between equity and debt. So about 10 to 25% in equity, about 70% to 75 to 90% in debt. A balanced hybrid, 40-60, 40-60, aggressive hybrid, more in equity, less in debt. And similarly, dynamic asset allocation is once again a similar equity debt dynamically. Sometimes when the markets are performing well, more equity. When markets are not performing well, more debt, so on and so forth. Right. So the fund managers keep doing this. We just have to choose the right fund according to us and invest our money into that particular. Cool. And now, finally, listen to this one very carefully. For everyone who's new to mutual funds, you must know about an index mutual fund. In fact, when anyone asks me, I am new to investments, where should I start investing? This is my answer that I give them, that an index mutual fund is where you should be investing your money. What is an index mutual fund? I'll quickly explain this, and then we have a lot more information on index mutual fund, which my co-host will cover. But before that, have you all heard about the terms Sensex and Nifty? Has everyone heard about the terms Sensex and Nifty? And do you guys have an idea what they are? Anyone here who does not understand Sensex and Nifty? Okay, so you heard those terms, but you don't have an understanding of what they are. Okay, very nice, very nice. Let me explain that to you. Let me take a minute and explain that to you. Have you all heard of a market called Connaught Place in Delhi? I come from Delhi NCR, so I hear of Connaught Place. But have you all heard of this market called Connaught Place? Yeah, Chandni Chowk, maybe Chandni Chowk might be much known name for those who have some understanding of Delhi NCR. Okay, now think of it this way, that today I, as a business owner, yeah, Connaught Place, Chandni Chowk. Okay, so now think of it this way, that I, as a business owner today, want to go and open a shop for my business. Okay. Now, before I open a shop, I will obviously do some market analysis that, in this particular market, what is the kind of business, what is the kind of footfall, how many customers come, what's the average sale price, how much profits can we make, so on and so forth, right? Before opening a shop, I will take an idea of that locality, right? I mean, just think of you opening up a shop in any of your locality, you will have to go and get an idea, correct? Similarly, let's say that I went to Chandni Chowk and get this idea. Now, Chandni Chowk has tens and thousands of shops, maybe lakhs of shops, right? It's practically impossible. It's impossible for us to go to each and every shop. And so, what I rather, instead of going to each and every shop, it would be very cumbersome, very tiring. What I rather did was I structure, I broke down the shops into categories. Let's say garment shops, restaurants, electronic shops, pharmaceutical shops, I mean medicine shops, right, jewelry shops, so on and so forth. And so now, instead of going to each and every shop, I went to the top three, four shops in out of these categories. And I spoke to the owners of these top two, three shops, and kind of made an assumption that okay, based on the kind of business that these top two, three shops are doing, all the other shops must be doing something or the other similarly, right? Make sense? Now, using this exact same analogy in terms of markets, in terms of mutual funds. In India, we have two major stock markets, the National Stock Exchange and the Bombay Stock Exchange. Companies listed in the National Stock Exchange. Now, in a day, how do we know whether the National Stock Exchange has performed good or bad? There are 5,000 plus companies listed on the National Stock Exchange. How do we know whether the companies have performed well or not? And so what the market experts once again did was they said that we don't have to go and check each and every company. Let's select top 50 companies from each of the various sectors: pharmaceutical, IT, finance, FMCG, so on and so forth, right? And based on the performance of these top 50 companies, we will make some analysis as to how did the companies perform, how did the market perform, right? So I hope you're getting the sense. The top 50 companies, the top 50 companies listed on the National Stock Exchange is called Nifty. The top 30 companies listed on the Bombay Stock Exchange is called Sensex. As simple as that, right? And any mutual fund that invests into the top 50 companies that are listed in Nifty is called a Nifty Index Mutual Fund. Any mutual fund that invests your money into the top 30 companies of the Bombay Stock Exchange is called a Sensex Index Mutual Fund. Cool. Now, why do I say that this is a great start for beginners? Think of it this way. If we as Indians think that India as a country is going to perform well over the years, we're going to become an economic power, a financial power, overall things are going to be better, then it's going to be very important for these top 50, top 30 companies to perform better, right? Because the better they perform, the more the taxes, the more the employment, the more the opportunity for India, the more the growth for India, right? And therefore, can I say that if these companies will perform well, and if I put in my money into these companies, then there is a high probability that my money will also grow along with it. Yes. And therefore, I feel an index mutual fund is the best way for anyone to get started with their mutual fund investments. Whether we go with a Sensex or we go with Nifty, you don't have to worry about it at all. You could choose any one of them. Clear? Yes, no, maybe? Okay, perfect. Perfect. Now, before I invite my co-host, there is one more important thing that I need all of you to understand. Okay. We talked about something called as Mission 1CR. And what is that Mission 1CR? This is my personal belief and this is my personal theory when I think about wealth building. What am I following personally in my life is what I'm going to now share with all of you, right? The journey of building wealth, I feel the journey of building wealth can be divided into majorly three phases, or rather four phases. The 0 to 1 crore journey in financial assets. Okay, I'm not counting real estate here. So in financial assets, which is your stocks, mutual funds, fixed deposits, PPF, so on and so forth. So the journey of building wealth can be divided into four categories: a 0 to 1 CR, 1 to 5 CR, 5 to 10 CR, and 10 CR and above. And I'm hoping that majority of us would fall currently be in the 0 to 1 CR bracket, right? We're all currently in our 30s and 40s is what I assume. And so what I feel is we are all currently maybe, in our journey from 0 to 1 CR somewhere or the other. And what I feel is it is very important for us to learn financial discipline in the 0 to 1 CR journey. You know what? What happens is the people in the 0 to 1 CR journey make the maximum mistakes. I have made tons and tons of mistakes. Because you know what? Sometimes we see a video saying that, Arey, that stock is going to do very well. Let's put our money there. Gold is going to do very well. Let's put our money there. Silver will do well. REITs, real estate investment trust will do well. And sometimes we'll be like, okay, nothing will do well. Let me just put all my money into fixed deposits. Right? A lot of us get that feeling. Now, what I'm trying to actually tell you all is, in order to build this first 1 CR of financial assets, you actually don't need to do much. You actually don't need to do much. All that it takes in order to reach your first 1 CR is a 3 asset strategy. And I often during our informal communications, I call it the 3 As because I feel this is a good way to keep this in our minds. But I can't put that on slides for obvious reason. But now you get the point, right? So you can also keep that in the back of your mind so that you will always now remember it. But a 3 asset strategy is what we all need. That's it. That's it. You don't have to go here, there, everywhere. All you need is a 3 asset strategy. And there is something that you must know, which is an 100 age rule. What this 100 age rule says, if you are 35 years of age today, 100 minus 35, 65% of your money should go towards equities, 35% of your money should go towards fixed income. That's it. 65% of your money should go towards equities, 35% of your money should go towards fixed income, right? Here is a sample portfolio that should look like. Out of that 65% of equities, 20% should go towards your mid cap mutual funds, 10% towards small cap mutual funds, 20% towards flexi cap mutual funds. Flexi cap will divide your money into all the mutual funds, and about 15% into index fund or large cap oriented mutual funds. The remaining 35% can go into fixed deposits, gold, silver, wherever you want it. But trust me, folks, I did not follow this for the entire 12-year journey of my investing so far. I just learned about it in, let's say, the last 6, 7 years, because the first 5 years, I did all the mistakes I could have done. I put my money in 10 different asset classes, 10 different schemes, and it kind of did not give me any benefits, right? And so what I, along with lots and lots of research, along with my co-founders, along with tons of experts that we interviewed, finally figured out that all you need is a simple, disciplined approach, and you will be able to reach your 1 CR in a span of 10 to 15 years. I also have something really interesting to show you guys, which is something that we've developed for all of you, which is a Mission 1 CR calculator, right? And what this Mission 1 CR calculator will do is it will tell you exactly how much you need to start investing from today onwards in order to reach your 1 CR of financial assets. Excited? Excited to see this? Show me some thumbs ups before I show you this calculator. Perfect. Perfect. Amazing. Okay. So what I've done here is I've put goal amount as 1 CR, expected rate of return. Okay. Now think of it this way. It's a long term. Okay. Folks, everything that we're talking about is long term. Okay. So don't think of it in any 1 year, 2 year, 3 year period. That's not going to happen. That's never going to happen. In fact, somebody asked me, how can I get 1 CR in 1 year? And I was like, I told him, start with 2 CR, you will get 1 CR. Right? So it's impossible to get 1 CR in 1 year. Okay. So what I was saying is 1 CR is your target corpus, expected rate of return. So we can say that on a long-term basis from equities, we can get about 12% return. And from fixed income, we can get about 10%, 8% return, right? So on an average, 10% return is very safe to assume. Okay. So we will take 10% as the rate of return. Time to achieve. Okay. We'll come back to step up, but time to achieve. I want to achieve, let's say 1 CR in 15 years of time. Okay. So I will put in 15 here. And there you go. The calculator gives me that I need to start investing 23,844 rupees every month from today onwards to achieve my 1 CR of target corpus. Now, some of you will be like, "Nahi, it's still not possible. Actually, do some magic." Okay, let's do some magic. So the first magic that we're going to do here is you will have some savings right now, right? Maybe 1 lakh, 2 lakh, 5 lakh, whatever could it be. If it's not there, it's absolutely okay. You could put zero. But for those of you who have some salary, how about, for those of you who have some savings, let's say if I have total of 5 lakh rupees of saving, I can just put that 5 lakh here. And there you go. Your amount drops down to 18,000 rupees. Right? Srinivas says my salary is 20,000. Don't worry, Srinivas, we have a plan for you as well. The point that I'm trying to make here is you could actually use this calculator and calculate it exactly for how much you need to save and invest, right? And finally, coming on to step up, a very, very important factor. Step up means that if today I start investing, let's say 18,000 rupees a month, and if I can step it up by 10% or 5% year on year, then how much can I make in a span of 15 years, right? And so let me put it as 10% to begin with, and then we can bring it down to 5. And there you go, my friends. All you need is to start with 10,000 rupees a month in order to achieve 1 CR of target corpus in a span of 15 years. The first year, 10,000. The second year, step it up by 10%, 11,500. Third year, 12,000. Fourth year, 14,000, so on and so forth. Don't worry, you will get those calculators, right? But are you getting the point? Are you getting the point here? Year 5, 15,000. Right? So all you need to do is start with 10,000 rupees. Assuming you have about 5 lakh rupees, you can get to 1 CR, right? Just play with these numbers. Make it 10 years. Make it 20 years for those of you who feel this is a bigger number, right? 4,000 doable. You will be able to achieve 1 CR in 20 years. That's the point, right? Don't worry. You will get these calculators. We will let you know how to get it. So you will have enough access to it. So I just wanted to share with all of you, as they say, tell me and I forget, teach me and I may remember, involve me and I learn. Folks, we're not done with the session. We have another half an hour. Okay, so don't go away. We have lots and lots of interesting slides, but I wanted to share this for those of you who might need to drop off, which is tell me and I forget, teach me and I may remember, involve me and I learn, right? What we want to say is tell me and I forget, which often happens, right? Everyone tells and he forgets. Teach me and I may remember, and that's what we've done today. We've taught you so that you remember, but I know all of you will forget this after the weekend. So therefore, involve me and I learn, and that's where we have created some communities that you can be a part of in order to be connected with us, right? This WhatsApp group is a dedicated group for Ethica and its employees and its partners. We have more than 150 people already. We would request all of you to join this so that any questions, and all of us are there on that group. If you ever have any questions related to anything about mutual funds, or any other personal finance topic, you can certainly join this group and ask questions here, right? We also have a YouTube channel where we are putting in a lot of videos. And in fact, all of these things that we've taught today are available in much detail and are coming, and a lot of new videos are also planned, which will give you a detailed insight into mutual funds. So make sure you do subscribe to that as well, right? Gautam, if you can put the link to both of these in the chat, that'll be really helpful. Unable to connect the WhatsApp group? Okay, we'll just check. Don't worry about it. We'll just check in the meanwhile, and in the end of the session, we'll share it with you again, right? But for now, just take a screenshot of it or just take a photo of it, and then you can come back to it, right? Don't worry. While I cover the remaining slides, the team will just check on it. And now, let me introduce you to my co-host, somebody I know. I had to give the slides half an hour before, but I took a lot of time. We had initially planned that I'll speak for half an hour and Mezjan will speak for the remaining time. But as I always do, I keep speaking a lot. First time it's throwing an error. Okay, guys, just try again, right? But let me introduce you to somebody who's actually learned once again by doing things on their own. Mezjan Dallas. Super excited to have him, as my co-host. He's been an investment coach. He's a certified investment coach by the Center of Executive Coaching, Florida, and a Gallup strengths coach. He's had 25 years of experience investing in mutual funds. So all the entire graph that you saw there, he's seen all those phases. He's seen the dot-com bubble crashes. He's seen the global financial crisis, so on and so forth. His website is the top Google search for investment coach, which is a really, really amazing feat to achieve. He's worked with the IT industry for more than 20 years and IBM, as one of the market leaders, and has tons and tons of experience from there. He left IBM at the age of 42 to pursue his dreams, his passions, and started working as a freelancer. And now has read tons and tons of books and tons of articles to be able to, come up or guide us on this scope of investments, right? I hope you can continue to see my screen, right? I'm sorry, there was some issue at my end. Okay, perfect. So please join me in welcoming Mezdan. I want all of you to once again give a huge round of smileys, huge round of thumbs ups and make Mezdan equally excited, just like you've made me excited throughout this session, right? Mezdan, over to you to share your insights and thoughts.
Thank you, Akshat, for that lovely introduction. But I must start with a disclaimer that says that I am not at all a hotshot investor, right? So I don't have any tips or tricks for anybody to become rich quick at all, right? I just have some, slow and steady tips and approaches some of which we will be discussing, right? So I'm a very fairly normal investor, nothing above average, I would say, right? So with that, I will just dive into my journey of learning, right, for the last 25 years. So learning about investing. So I want to start by just saying that, I've put this slide here first because that is the most important thing in my view, right? If from my perspective, from the few slides that I'm going to show you all and talk through today, if you all do nothing other than this, right, and take away this one, tip or input, it would be that you should educate yourself as you are today, sitting in this session. You should keep educating yourself continuously about investing and learn about investing. There is nothing to beat that and nothing that can replace that, right? You have to learn and you have to, set yourself in control of your investments, right? So my journey started with reading a magazine called Mutual Fund Insight. At that time it was a hard copy that used to come, I think maybe nearly 100 rupees, right? So I started in about 2000 or 2001 by reading Mutual Fund Insight. It comes from this extremely well-known company now called Value Research, right? So I would, I of course would highly recommend that to anyone and everyone, right? And then I started using the data on Mutual Fund Insight to pick funds and do my own analysis based on Value Research data. Right. Then, of course, I went through multiple financial advisors. I think I went through maybe at least 3 financial advisors along the way. Right. But one of the things that happened, one of the main patterns that emerged, right, for me was that I would select one fund, right, which had very good ratings, very good, return results, etc., based on Value Research data. I would choose 3-year data, 5-year data, 7-year data, 10-year data. I would do all kinds of analysis and I would pick a few mutual funds, 3 funds, 5 funds, whatever, right? And then after a little while, maybe 1 year, maybe after 2 years, I would find that, this fund is not doing well. Now what should I do? Right? So I would feel bad that other funds are doing better. And my fund, which I chose 2-3 years back, is now not doing so well, right? It was at the top of the pack. Now it is coming to the middle of the pack, or it is from middle of the pack, it has gone to bottom of the pack. And I would keep switching the funds to the currently best performing fund, right? And I was managing, of course, multiple portfolios in my family. I was managing my own, my wife's, my mother's, all sorts of things. So across all 3 portfolios, I kept doing the same thing. And I think I have switched nearly 180 mutual funds over the last about 20 years, let's say, right? So I finally, I decided, okay, now I want to clean up my portfolio. I want to make sure I have, just as what Akshat showed you earlier, right, in a couple of slides back, 65-35 portfolio. I one good thing that I started doing after that is that I made a very clear asset allocation between large cap, mid cap funds, etc. Right. So that clear asset allocation was, I think, one significant improvement and learning in my investment journey. And so I would highly recommend that. Right? Have a clear segmentation of how much in large cap, how much in mid cap, small. Because I had value category also. Right. That was one big step. But then I think the major step that came was that I moved from reading magazines, and of course, Value Research and Mutual Fund Insight are excellent magazines still, to reading, books, 200, 300, 400 page books on investing by, some of the gurus. Most of them are in the US, of course, right? So I started by reading this strangely titled book called Lazy Person's Guide to Investing, but I highly recommend that to everybody, right? And then I moved on to multiple books. I think I must have read at least 7, 8, 9 books of 300 to 400 pages by people who are, gurus of investing. So I highly recommend that you keep a journey of learning. Start with Mutual Fund Insight, and then of course pick who you want to follow, which gurus you want to follow, and which people you want to follow, and continue that. I finally became, as it's written there, a DIY, do-it-yourself investor, right? And I focus mainly on index investing, as we will see later, right?
So,
Okay,
folks, one
so
thing that I want all of you to actually pay attention to is Mazedan at a time has gone over 180 to 200 mutual fund schemes, right? That number may not look that big, but it is huge to be able to experience that, he's being invested in so many schemes. And then finally, he realized what was wrong, what was right, and then kind of made his own strategy to become a DIY investor. Right?
yeah,
So just wanted all of you to pay attention to that.
right. Thanks, Akshat. Yeah. So let's move on to the next slide then.
I want that strategy too. Absolutely. So that's exactly what the next couple of slides I want to
Yeah.
talk about. Two types of investments, active investment and index investment or a passive investment. Mazedan is going to tell you what passive investment is, what index investment is, and what kind of people is it best for, right? So that's exactly what the next couple of slides I want to talk about.
Right. Correct. Folks, one of the first questions that anyone wants to know as soon as you talk about investing is, which fund should I invest in, right? But I think that might be question one. Then question zero is, what category of equity mutual fund do you want to invest in? Is it active or index? Okay. That is the question zero that you should be asking. Of course, there are different types of people, and active will suit one set of people and index will suit one temperament of people. We are going to cover that in the next slide also. But just to give you a sense or a feel for what is active versus index, I have created an unusual sort of analogy, right, between two bikes that I have ridden in the last, let's say, 1.5 to 2 years, right? One was a really very powerful 750cc Suzuki GSX 750 sport bike, right? And the other is a very fairly comparatively plain Jane Yamaha R15, right? Now, if you look at it, the one that I started with initially, right, extremely fast, can reach 112 kilometers in the first gear, right? Very, very fast, incredibly powerful, right? So basically, high return, as in high speed, but also high risk. When you go at high speeds, we all know what the risks are. It has extremely sharp brakes. And the feather touch causes the bike to almost tip over and fall, right? So the moment you go aggressive, and if you go more aggressive, you must expect and be ready for the risk side of that as well, right? The bike was also very difficult to manage, heavy, difficult to do U-turns, hard clutch, servicing difficult, right? All of these also compare with active funds. When you have active funds, it's not a fill it. Remember the old Hero Honda ad, fill it, shut it, forget it, right? So index funds are fill it, shut it, forget it. Active funds, you cannot forget it. You have to keep reviewing, you have to keep monitoring, you have to make sure that you are on top of things, and then you make whatever changes are necessary at whatever frequency you think is fine, right? I did that for 180 mutual funds. I got tired. I said, ye meri bas ki baat nahi. This does not work for me. This does not suit my temperament and my nature. So I am moving to index funds. That is not necessary for every one of you or even half of you, right? Based on your temperament, you will have to take a decision. For me, the Yamaha was a much lighter bike. It can cruise up to 100 kilometers an hour very easily. That's good enough for me. So I said, that's good enough for me. Doesn't have very sharp brakes, but it's good enough for me to stop at the speeds at which I ride. Good enough for me. I can make easy U-turns. It's lightweight. I can service it here. Clutch is light, easy to ride in the city, right? So I finally chose that. But I hope that through this slide, you get some feel for the difference between active and this thing based on your nature, active and index funds based on your nature, right? What if you prefer significant simplicity, you will probably prefer index funds, right? Okay, let's move on to the next slide. Okay. Right. So yeah. So finally, of course, like I said, this is the ultimate in simplicity. So my portfolio, which went through, 15 funds at a time, probably 20 funds at a time, and went through 180 funds. I finally am now to basically three funds, right? I have only three mutual funds for all my portfolio. One is a Nifty index, Nifty 50 index, 40% of my portfolio, 10% is US S&P. It's actually now about 13%, right? And debt funds are 50%, right? Also important to note, I did this, I came up to 50% very slowly, right? So if you have to think of me, like I said, I'm not a hotshot investor, right? I don't like to do the rabbit and the tortoise story we know, right? I don't do rabbit, I do tortoise, right? So this tortoise that I increased my asset allocation very slowly over SIP over 10 years to reach 50% today, right? So that is my portfolio. The thing is, it is extremely simple to manage, right? I have very few transactions. I do less than 4 transactions in a year, probably overall, buying or selling. Right? It's very easy to manage, very easy to rebalance. I don't know. I think compared to the number of hours I used to spend, I spend very, very few hours. I mean, I think I can do my investing in less than 10 hours for a whole year. I don't need to spend more than 10 hours on my investments for the whole year, I would say. Right? So that's that. Okay. Let's move on.
Yeah,
That's
and just
simplicity.
just wanted to like kind of add here, right? So for I hope all of you are able to see that Mazejan is at a 50-50 split, right? Now a lot of times people say, hey, no, you should be 70% in equity, 80% in equity, 60% equity. And then again, we gave you an 100 age rule, right? 65-35. But at the end of the day, what you have to remember is what works for you, right? As Mazejan said, he was more on the debt side, he was more on the fixed income side, and slowly and steadily, once he started understanding equity, that's when he started moving his money from fixed income to equity, right? So the point being, to each one its own, see what is comfortable to you. It's personal finance, right? The word personal is very important. What suits us is what we need to do, right?
Correct. Perfect. Perfect. Yeah. That said, the rule you presented of 100 minus age in equity is a very, very valid and a very good rule. So if anybody is not able to figure it out, you can start perfectly with what Akshat said in the slides earlier, right? Okay. So what kind of person, right? So this is just a quick checklist. You all can look through it, right? You read through it and see if, how many of these would you give a tick mark to? If you give a tick mark to a majority of these, let's say four or more of these out of 6, you are probably going to be quite happy to be an index investor. If you don't give a tick more to more than 3 of these, you should definitely consider active and be an active fund investor, right? If you see other funds and asset classes generating more than your index and your fund, and you feel upset and bad about it, index funds is not for you. Yeah, if you're just happy enough that your investments will get you to your goal or beating inflation, all good, right? If you're a person who likes spending time on hobbies, etc., and you don't like looking at investing and reviewing your investment, doing all that hard work, then you are probably likely to be a good index investor, right? So simplicity, if you like simplicity, you want time for your hobbies, etc., and you don't get hassled by other people's returns or other funds going ahead of you, then you are okay. It's like that toll gate, right? I mean, I didn't mention the toll gate analogy, but that's what I noticed. When you go to a toll gate on a highway, you choose one lane out of 5 or 6, which seems the shortest and fastest, right there. And then you start looking left and right, and you see, oh, the other lane is going faster, and you start feeling bad. If you are a person who starts feeling bad that the other lane went faster, please don't do index investing. Please do active mutual fund investing. Otherwise, with index investing, you will always feel bad because you will always see somebody on left and right who is doing better than you. Okay.
Always happens with me. Always happens with me. And I'm like, why is my lane not moving?
Right. Right. Yeah. Okay. So let's move on. Yeah. Yeah. So the summary in terms of active versus indexes, identify what suits your nature and temperament. Identify something that you can stick to. Choose one style and then stick to it for the next 15 years, right? Don't keep Now active, now index, now active, now index. Don't do that, right? Choose one, stick with it for 15 years. Most importantly are the last 2 points, according to me, right? Make sure you have tools and you are clearly and accurately measuring performance of your funds, right? It is not that easy, right, to measure accurately performance of your funds, but now there are enough tools, so use tools. And make sure once a year you check each of your funds against its index, right? Check if it is beating its index or not beating its index. Okay, let's move on. Yeah. Right. So this is one really simple starting point, right? The last point I made is check your fund against the index, right? So how do I know? It's like we all know, right? When we are in school, we know we got pass mark or fail mark. I don't know, it's 45 marks or 35. I can't remember now, even I'm too old now. But let's say it's 35, right? In engineering, I think it was 35 was pass marks. So we know, did I pass? Did I fail? I got above 35, I passed. I got below 35, I failed. The equivalent of that in mutual funds is for each mutual fund that you have invested in, check that it is beating its index over the long term, right? So how do we do that? Right? You go to this website called Advisor Coach, okay, which Akshat is now going to show you, right? And maybe Akshat, you can only take them through the steps as you're clicking, right?
Sure, absolutely. So, right, guys, go to Advisor Coach. You'll see this on the top. Go directly to advisorcoach.com. I'll just maybe increase the size a bit, right? Yeah. Again, no affiliations with this website. We just use this for our own research purpose, and therefore we are showing it to you. So you go to advisorcoach.com, go to MF Research here, right? You see this MF Research as a second tab. Go here, and then you select rolling return versus benchmark. So there are two options: rolling return versus category, rolling return versus benchmark, right? You can choose either of them, but benchmark will give you a more accurate understanding of your pass and fail, right? And so rolling return versus benchmark, if you go here, so you can think of it this way, right? The example that Mezdan shared, rolling return versus benchmark is obviously that 35 limit, right? Rolling return versus category could be your friends' scores, right? How much did my other friend score? How much did my other friend score? And for some of us, it could just be like, I have to just score more than this person. So that could be the rolling return versus category, right? But anyway, so go to rolling return versus benchmark, and this is exactly what you need to do, right? So whatever mutual funds that you have today, you will be able to select that from here. So anyone wants to put their mutual fund scheme's name in the chat quickly, we can look it for you. But in the meanwhile, I will just open any random one. So let's say Access Large Cap Fund. Okay, somebody's already started putting DSP, ELSS, Parag Parekh Flexi. Okay, let's select Parag Parekh Flexi. Yeah. Okay. And what I've done is pre-fill the start date with inception. So since the time the fund has started, we've just chosen that. And then 2013, right? So we will take a 10-year period, right? 10-year period is good enough for us to understand, and click submit. And now you see the yellow line is the Parag Parekh's performance. The blue line is the index or the benchmark's performance that they are following. So benchmark followed here is Nifty 500 TRI, right? Nifty 500 means the top 500 companies listed in Nifty is what they are measuring their performance against, right? Why is that? Because top 500 will have large, mid, and small all. And Flexi Cap is a fund that invests into large, mid, and small all, right? So that's why that index is selected. And it's been consistently beating. So, you can also see the details here. You can read through them. And that's how it works, right? I'll maybe choose one more. Let's do Motilal Midcap. And you can all do this, right? So don't worry about it. In fact, I'll just mention uh, I'll just share the link here as well. Okay, this is an interesting one, right? So Motilal Midcap Fund, it was performing well. It was actually performing well since 20 till the year 2015-ish. And then you see since 2015-ish, it has it has not beaten the benchmark. So since 2015, if you look at it, the fund has not beaten its benchmark. So it is not a pass, right? This is something that you must, so I think somebody had put it in the chat, Mr. Ramesh, you must look at it. You must review your mutual fund investment portfolio with your advisor or, whomsoever you were working with. And you should certainly look at this, right? So it's not actually been performing since, I think this since 2025. I think the dates, it says March 2015 to 2025. Yeah, it's the rolling return that it's giving, right? So you should certainly look at it as well. Okay, I'll look at just one last one, Bandhan small cap, and we'll pre-fill this as well. It started newly, so I don't think it'll have a 10-year data. Yeah, it won't have a 10-year data. It will just have a 5-year data, right? Since it started since 2020. And yes, it has beaten the benchmark. Hitting the benchmark, right? In the beginning, it was not, but later on, it has. Cool. Okay, don't worry. You can actually go ahead and do this all on your own. Let me just once again share the link with you for easy access. There you go. Cool. Okay, back to you, sir.
Okay, great. So folks, I want to reiterate one thing that I said when I started my few slides was one of the most important things is to keep a continuous learning journey, right? So this is the second most important thing I'm going to say, right? If you listen to even just two of these things, the 20 minutes you have spent listening to me will be 100 times worth it, I can guarantee. So the second thing is make sure that once a year at least, you check each and every fund in your portfolio against its index using these steps which Akshat has just shown you on Advisor Coach, right? If you don't do anything else, according to me, you will do pretty well with your investment. You keep continuous learning. Read one book a year, read one magazine a month, whatever, and you do this, you will be fine. Right? Really, I cannot overemphasize. Extremely important. Make sure you benchmark each and every fund against the index, right? Okay. Then, so here is another slide which I know everybody is excited about because the market is in a dip right now. There has been some correction, etc. Everybody is worried about the Iran war and everything else, right? But I must start this slide with the disclaimers which are in the stars at the bottom, right? So this slide we will read from bottom first and then we will do the top, right? The star right at the bottom is this is only to be used as a guideline, not as a rule, and by experienced investors only. So please be cautious. Don't do this on your own. Feel free to reach out to Akshat or me or anybody, and we can always help and guide you. But this is a thumb rule that exists. So I am sharing it because a lot of people are interested in it in this market condition, and it happens often, these kind of markets, right? But be cautious, right? Don't get overboard and don't, get overconfident unless you're an experienced investor. Second point is all of this is based on, as the title says, Dr. William Bernstein's research, and it is his advice. This is not my advice at all. I am not capable of giving such advice, right? Dr. Bernstein has written over 10 books on investing. Many of them were, New York Times bestsellers. Okay. He is frequently interviewed on CNBC and handles only portfolios of people with $25 million minimum, right? You have to have minimum 20. So he's an extremely credible voice. Some of the greatest advisors in the US listen to Dr. Bernstein. I am also a great fan. I have read at least 3 books of his out of 10, right? So this is based on his advice, somebody who is extremely credible, right? So I'll go through the bullet points. Buying the dip, of course, we know is about buying more equity when the markets fall. It's like saying if the tomatoes have become cheaper, don't we want to buy more tomatoes? So same thing you want to do here. Stocks have become cheaper. Wouldn't I want to buy some more stock, right? The problem with doing that is first, when stock market starts correcting or falling, we don't know how long it will keep falling and by how much it will fall. I don't know. You don't know. And, as somebody said yesterday on a group chat, neither does Warren Buffett know. Correct? So nobody knows. Nobody on the planet knows. Right?
Sir, just
Problem two
adding
is,
one word. Sir, I read some Warren Buffett thought, and that they said like in that book, never catch the falling knife. So
yeah,
yeah.
correct. Right? So we don't know. Right? And when it has fallen, like today, currently maybe it has corrected 5% from recent times and 15% from last 24 November, right? We don't know how much should I buy because it can keep falling for next 6 months, 18 months, 24 months. We don't know how long. So how do I buy? And to solve all of this, Dr. William Bernstein has done the research, right? based on the worst market falls in the US. And he has come up with this fairly simple guideline. Let me quote again. It is not a rule. Don't follow it like a mathematical formula too much, but there is a guideline which says you increase your equity allocation by 1/5 of the extent of the fall. So now I'll explain this with this example on the table. Okay. Follow the example if you can, right? Assume you have 60% equity, 40% debt, and assume the market falls today by 25%, right? So if you had 60% before the 25% crash, 25% of 60 is kitna? Yeah, 15%, right? 6 plus 6 plus 3, right? So now suddenly tomorrow you will find that your equity portion has become 45%, right? Now what is Bernstein saying? Increase your allocation by 1/5 of the fall. How much was the fall? 25%. 1/5 of the fall is 5%. So you have to increase your equity allocation by 5%. Your equity allocation was 60%, right? 60. 5% of 60 is 3%, right? So no more, what people mostly do is you can just rebalance, right? So you can say, okay, market has fallen to 45%. Let me rebalance, let me bring it back to 60. What Bernstein is saying is if you really want to take more advantage of a fall, you can increase it. But how much to increase? Increase it by this 3%. So a person following Dr. Bernstein's rule, person doing normal rebalancing will come back from 45 to 60%. A person who wants to make more advantage of this dip will say, instead of 60, let me go to 63%, right? I hope this is somewhat clear.
Yeah.
And
so basically let's just work around this with a whole number, right? So let's say I have 1,000 rupees of money in my equity, right? So with 1,000 rupees, let's say 60% was 1,000 rupees, right? So 1,000 rupees is my total equity. Market has crashed by 25%, as Mihjan said. And so 5% of 1,000, how much is that? 50 rupees. So 50 rupees worth of additional equity will I buy. If let's say the market crashed by 50%, whatever was the topmost position, now it's crashed by 50%, I will buy 10% more. So 1,000 ka 10%, 100 rupees, right? Post the crash wave, my total equity should be 1,100 rupees out of the total investments that I have. Right?
right.
Folks, is everyone clear with this? I know this could be a little confusing, and that's why we want to take a pause. But yes, can I have a quick round of thumbs ups if everyone got this? This could be the best guideline that we could share with you in order to help you with all your questions of should I buy the dip? Should I buy the dip?
Yeah.
Okay, perfect. We've got at least few thumbs ups. I know you all must be tired now, but give us another 5-10 minutes and we'll be able to
Yeah. If anyone has any doubts, feel free to reach out. Akshat will connect you to me or whatever, right? Or we can just
Yeah,
help
we'll
you
just
with
share
that.
our LinkedIn's in the chat. Yeah. Cool.
Yeah.
Okay.
Yeah. Akshat, I'm just thinking if you want, should we just continue to your slides given the time, or
Sure.
cover?
No, I think we're pretty much done, right?
Yeah.
So yeah, folks, I mean, if you want to quickly wrap this
Yeah.
up in a minute.
So yeah, we're just wrapping up in terms of various things. If there are 4 fundamentals that you should focus on, according to me, there is multiple research that backs up all of this, right? The mistake not to make is which fund should I buy? Everybody comes to investing and says, which is the best fund to buy? That is the absolutely wrong question to ask, and it is the absolutely wrong thing to focus on. The right 4 things to focus on if you want to really become a successful investor are have a clear plan. Goal-based investing, somebody spoke about, right, in the questions. Make sure you have a clear asset allocation, which is what Akshat spoke about in the 65-35, your age in bonds rule, right? Number 3, be very careful about how much your funds are costing you. Keep track of the fees of the funds as well as the taxes you're paying, and decide what strategy you want. Do you want to do SIP, lump sum, etc. Right? These are the 4 most fundamental things, opposed to which fund should I buy. Everybody comes in saying which is the best fund to buy. That is the last question you should ask. That is question number 5. You should come to that, but you'll come to that after dealing with points 1 to 4. Okay, that's that. Thank you for your time, and I'll over to Akshat.
Absolutely. Folks, did you learn something new? Amazing. No, thank you, Mason. That was super amazing. Super interesting. And yeah, the poll has come up, so do answer that poll. And in the meanwhile, I will quickly explain you, how to. Naresh, we'll just cover. I'll just cover all the slides and then we'll come back to the tip slide. Don't worry, we'll stay for as long as you guys want us to stay. We just want to be mindful of everyone else's time. So let me just cover this and then we will make sure that we go back to the tip slide. Cool. So here is a simple thumb rule, folks. Long-term investing, equity mutual funds, short-term invest, and equity has the index funds, right? So remember, when I say equity funds, index funds, large cap, mid cap, small cap. But one thing that you should be sure is you need minimum 5-year time horizon. So if today you are selecting any index fund, if you're selecting an equity fund, you have to stay invested in it for a minimum of 5 years, right? If you have less than 5 years, say 2 to 5 years, you can choose hybrid funds. You have the conservative hybrid, balanced hybrid, right? Remember the one in which it just gets mixed into both equity and hybrid. And finally, less than 2 years, please don't even look at equity. Only stay invested in debt mutual funds. Okay? Only stay invested in debt mutual funds. Cool. Now, what all to look for in a mutual fund? So many 38 categories, 45 plus SEBI registered, 3000 plus MF schemes, so many things to look for. How do we actually look at it, right? And then, we have all of these technical parameters. And again, we won't be able to go into the depth of these technical parameters, but happy to share some videos. In fact, if you go on to our YouTube, we have done this discussion in depth. I will show you that in right a minute before we move on to sharing some AI prompts that might be able to help you, right? So I will just share something with you for our for those of you who want to learn mutual funds even in depth. So this is how our channel looks like. And if you go on to playlists here, right? Under this playlist section, you see fundamentals of personal finance, right? Now, if you just click on this view full playlist, we've put in a lot of videos here, chapter by chapter. Module 1, if you see module 1, chapter 1, module 2, 1, chapter 2, module 1, chapter 4, so on and so forth, right? So each and every video is actually following a hierarchy. And module 8, so it's all basics of personal finance, starts from the very basic, right? But module 6 and 7 is actually all about mutual funds, right? So what is a mutual fund? Types of mutual funds, types of mutual fund plans, ways of investing your money, the SIP versus lump sum, all of those things that we shared. And then the category, the right mutual funds, a historic example, and this, how to choose your category and choosing the right mutual funds. Both of these two videos, chapter 21 and 22, go into the depth of actually looking into all of these technical parameters, right? So make sure you definitely view this. In fact, I will. So this is how the looking at it video goes like, and I will, for easy access, share the video link here as well. But this will certainly give you a very fine understanding of how do you actually go into the website, look at the parameters, and select a mutual fund for yourself. For those of you who still have questions, we are more than happy to answer all of your questions, right? And finally, just in order to make your life a little easier, what we thought was, why not give you some AI prompts, right? So we have created 3 prompts for all of you. And let me actually work out these prompts right in front of you so that you can actually understand what all of this works like. And so the first prompt that you see on my screen the first prompt that you see on my screen is about fund selection, right? It says as a mutual fund, and the prompt it says is act as an educational mutual fund research assistant for an Indian retail investor. Your role is not to give financial advice, but guide scheme selection using suitability, risk, and consistency check. This is my goal. Firstly, ask me my investment goal, time horizon, and so on and so, and then suggest me all of these things, right? Here you go. I'll copy this and I will put this in my prompt. Let's see what this does. I'm doing it right in front of you. So it says, I need few details about your situation because that's what we told him, right? And so let's quickly give him. I will choose the investment goal as wealth creation, and feel free to put it in the chat if you guys want me to select something. 10 years is the time horizon. I'll say my risk comfort as high since it is 10 years. I want to go the SIP route. And do I have any existing mutual funds? I'll say no, no mutual fund, right? Let's just see what it does. I'm not selecting any. I will, Srini, I will, right? And there you go, funds. There you go, folks. It started giving me that for a 10-year time horizon, maybe flexi cap equity funds could be a good one. And now it has started showing me some shortlist, some well-known flexi cap funds, right? Again, no recommendations. We are just telling you how can you leverage AI. We're not telling you to go and invest into these funds, but this is how you could do all of these research, right? Similarly, let's say you could say, no, I want to invest only in index funds. That's it, right? It started giving me some of the known indexed funds as well. That's the point, right? Yes, yes, don't worry. All of this is made for you. We will certainly share all of these things with you. In fact, I don't know if I can. Okay, let me actually share this with all of you right here and there itself. But we will also share this over an email. Here you go, right? So level one is fund selection. Level two is fund comparison. Now, in case you have two funds, how do you compare both, right? So you can certainly actually also use this AI prompt if you're already having investment in two different funds and you want to compare how both of them look like. And level three is for those of you who are actually investing money. So in case you want to look at your existing portfolio, this is what you could do, right? And what I'm going to do is I will actually put up my CDSL statement and do it right in front of you, right? So once again, act as a mutual fund portfolio review assistant and do all of this for me. Correct? That's exactly what you can. No, I think it did not get copied. Still showing me the. Right? Here you go. And what I will also do is, as I said, I will try and share my CDSL statement. Here is my CDSL statement. Don't show the numbers. I don't want you all to know, but tell me, how does it look like? And there you go, folks. It started giving me an overall impression of what my funds look like and how is the overall portfolio allocation, so on and so forth, right? So it says that I have multiple categories. I do have an index as well because I really, really feel an index fund is important to have. So I have one index fund, but apart from that, I keep trying other funds as well because, as I said, I am the kind of one who actually gets really worried if the other toll line is going faster, right? Just the example that Mezdan had shared with you. But that does not mean that I am doing well. Even if I stay in index, I could be doing absolutely fine, right? So, but again, the point here is we wanted to share you all the sorts of perspectives that you should know before making a valid or before taking a informed financial decision. Cool. You have the AI prompt, you have everything that you needed to. And I think with that, we can kind of wrap up the content that we had. Yes, yes. And before we wrap it up, so here is obviously the WhatsApp code. I think it should start working again, and we will now start taking your questions too. So if there's anything that we've missed from the chat, I would highly recommend you all to use the Q&A section and start putting your questions. But in the meanwhile, yes, as I said, please do subscribe to our YouTube in order to get a lot more videos. And as I said, we want to create content for you, right? So please do join the WhatsApp group. If there are any questions you guys have, just add it in the WhatsApp group and we are more than happy to answer them there. And in fact, even create detailed videos for all of you. Right? That's the intention. That's what we're doing. We want to create a school of personal finance. No selling, no telling, giving you advisory, but actually helping you. How do you go about your investments? That's the intent. That's the intent. The group is not full. I heard somebody saying that the link was not working for the first time, but it started working on the second time. So just check once again. It should work. We're good for it. Let's move on to the Q&A, right? I'll let it be here and we'll move on to the Q&A. Gautam, did you flag any questions? Do you want to start taking any questions? Why do we have BSE and NSE? Srini, that's a good question. Why do we have BSE and NSE? Why do we have markets? Why do we have a market near your home? In order to buy and sell things, right? So today, if I am running a business, how will I? Okay, so one thing, why do companies list on stock market? When they want money, when they want money to grow, correct? Now, how will they act? How will they take money? Only when they are available in the market, right? So now think of it this way. Reliance has a shop where they are selling stocks. Okay, Reliance has a shop where they are selling stocks. Now, how will you sell stocks? You will sell stocks by having a shop, correct? So if you have a shop and you have Mr. Ambani sitting on the shop and telling you, okay, come give me 1,000 rupees and take one stock from me. That's why you have the market, right? So same way, just think of it. Now they're listed on the stock exchanges. So that's how the BSE and the NSE have stock exchange. That's the best answer I could think of right now, but I hope that gives you some understanding. Malesh has said, Scott just sent you unwittingly Slack on this. Yes, and yes, and changing the way they are being used this year. Colin signed agreement. I am not sure if this is relevant. Okay. Malesh, I did not really get your question. If you want to join us here and cast, that is also fine. With current market situation, index fund is better to go with. Amit, I think Nathan has really answered that. It does not depend on the current market condition. It depends on what you really want to do. It's a style of investing, right? So what you really want, that's what exactly you need to think of. Why do we have BSE, NSE answered? Is there any way to get 22% returns every year through MFs? That's no. There's the short answer to it would be no, right? And you should not even think of it, because the way once you start thinking of it, even a 12, 13, 14% return would not suit you, right? So don't do that. Don't ever assume 22%. Always assume a 10, 12, 12%. Cool. Please cover these topics if possible during the end. Mutual funds are usually presented as goal-based. Oh, Viraj has some really good questions. Viraj, are you still here? Folks, I'm using the Q&A. So please put your questions in the Q&A. It'll be easier for us to track. I know some of you are still in the chat giving it, sending it to host and panelist, but on the bottom of your screen under raise hand, you will see Q&A. Please put your questions there. It'll be easier for us to track. Okay, so Viraj has a good question. Mutual funds are usually presented as goal-based and long-term, but in real life, there are multiple life phases where we need to withdraw money along the way. With rising urban costs and children's school fees, there is often a constant feeling of, am I investing too little? How should a retail investor think about goal-based investing when real life cash flow needs keep coming? Excellent question, Viraj. I'm so happy that you asked this. This is where your financial planning has to come into picture, right? When we talk about financial planning, one of the most important things that we do is we actually ask you to start putting down goals that you have to track, right? There is another rule that we often talk about, which is the 30, 20, 50 rule, that 30% of your money you should try investing for long-term goals, for all these goals. But for all your short-term goals or your immediate needs, you should have a 20% bucket. You should have one bucket which you can actually withdraw money from whenever you have a cash flow issue or whenever you need money for a short-term goal, right? So that solves it that way. But on your first one, it is very important. So let's say if you today have 5 goals, what I would suggest is you must have invested into 5 schemes or 5 type of funds so that you are able to select for each of those goals. I hope that answers your question. Related to that, how does one practically decide what percentage of monthly income should go into investments? I think this is what I've kind of covered. 30-20-50 rule is what we talk about. And, I'm not trying to kind of market myself in any way, but all of these questions have answers to in the form of videos in the playlist that I showed you, right? It's a fundamentals of personal finance course. It's a complete course that will answer all of these questions. So do try and view that once, because a lot of this will get answered. So 30-20-50 rule is the answer to your part 2. For a working couple, should both husband and wife have separate SIPs, or is it better to have one SIP in the space of a spouse? I would say both. I mean, when you do both, you save taxes, right? Because instead of having the tax liability on just one of you, you will have divisions of tax liabilities, and when you have and you will have some tax-free incomes brackets as well, right? Even when it comes to capital gain or selling profits, so on and so forth. So I would always suggest, and more than that, it's the mindset also. In that case, both husband and wife equally feel confident, when they look at their portfolios. I hope I was able to answer them. Oh, yes, I see a comment from you. Thank you. When choosing funds, what are your thoughts on the current AUM of the fund as a criteria? Amit, I would not say that is one of the major criterias, but it's a good to have a criteria, right? So, I mean, you may want to select funds that are not too large, but at the same time not too small as well. So somewhere in the middle is what could be a typical selection. Just because when it comes to funds being too large, it is sometimes tough for the fund managers to manage things. But having said that, some of them have consistently been performing very well, right? So it is not, I would say, the only criteria, but maybe let's say if you're down to 2 funds and you want to see, and let's say one fund is 20,000 crores, one fund is just 3,000 crores, right? So I might want to go with the one that has 20,000 crores. Okay. There is a thing as dip and buy going on market, like investments, like instead of investing 10K, we will check market every day 3 p.m. and there are 20-30 ETFs. Whichever ETF is more down at 2%, buy it in short. Should we follow the as I said, I have not done this ever, and I don't plan on doing this ever, right? It is practically impossible. Tell me honestly, is it possible with the job that you have? Is it possible for you to look into market 3 p.m. every day, every single day? If yes, think about doing this. I wouldn't even say do it. Think about doing this if you can. But if not, don't fall into all of this. It will not matter. Acha, tell me one thing. Tell me one thing. What's the capital? Are you going to be able to put in upwards of 50 lakh rupees? Think, what we have to think is 2% on 10,000 rupees means 200 rupees. What will 200 rupees do in your life? The people who do this are trading in crores and crores. For them, 2% means a lot. It does not mean for us. We are retail investors, right? So unless you have capital worth 50 lakh to invest into one trade and take the risk of earning 2%, don't do this. Don't do this at all. I started SIP in Parag Parekh in 2021, but at that time I had selected AMC and I want to step up. The option is not available. Can I put lump sum in the same fund every month with the regular SIP? Yeah, absolutely. So you can either put lump sum or, you can also, so you can start another SIP in the same fund. If the step up option is not there, a lot of apps don't give that option, but you can also just start another SIP in the same fund. So that will help you in itself. Yeah. Hope that answers. I have started saving in first ECN. Please give me the genuine and Daljit ji, I'm so sorry, I don't understand that. First ECN. Gautam, Nisjan, any idea about this question? I've started in saving.
No, Akshat. Didn't understand what ECN is.
Yeah, yeah. Uh, Mrs. Daljit, if you can, like just send us the question again. Mutual fund versus LICs versus ULIPs. Brief idea. Great question. Mutual funds, investments. They invest into stocks, they invest into fixed deposits, so on and so forth. They invest all across asset classes. LICs and ULIPs are insurances. They are not investments. LIC is a life insurance corporation. It's actually a company that sells insurances. ULIPs is a type of insurance, unit linked insurance plan. These are plans that you should use for your life insurance. And once again, in life insurance, there is something called as term life insurance. So all of you must have a term life insurance. You're attending in a session by Ethica. If you have any doubts, reach out to them. There is super, super helpful team. So term life insurance is one that all of us must have. Apart from that, I would strongly recommend you really don't need ULIPs and LIC. I mean, ULIPs and other sort of plans. All you need is mutual funds, right? ULIPs are actually mutual funds and insurance linked together, right? In the long run, it might not be very helpful because a term insurance is what you really need. ULIPs do not have a very big cover, right? And so you can get a bigger cover for a lesser premium when you buy a term insurance, right? I hope that answers again. Can you explain how the compounding works in an equity direct growth fund? The increase in NAV can be considered as growth, but where does the compounding come from here? Absolutely, Nishant. So that's the mathematics, right? The NAV increases. So let's say today it was 10 rupees of NAV. Tomorrow the fund performed well, it became 12, then that became 13, 14, 15, 16. So the compounding is nothing but how much did that value grow on the face value of 10 rupees. So when the mutual fund started, it was 10 rupees. Slowly and steadily, it's now growing. What's the kind of return that you are getting on that? Right? That's how compounding is calculated. Okay. Any other? Is SIP better or lump sum better? Okay, let me ask you this. Vasumati, what do you mean by SIP lump sum? SIP means systematic investment plan. Every month you are able to invest. So if you're a salaried person, SIP is the best way because every month you're getting a salary and you can put in some amount from your salary into the investments. What is a lump sum? Lump sum means that you are investing once and you are not investing again, right? So lump sum is good when you get a bonus or you get some money from somewhere altogether, and that's when you can use the lump sum to invest more money. But SIP is the usual route it should. So for example, for me as well, and for all of us here, we all have our SIPs. No matter what the market is performing, every month some amount will go and get invested into our corpuses. Apart from that, if we ever get some bonus, if we ever get some money from any XYZ source, that's when we would use the lump sum route, right? That's the difference between both. Can we combine both LIC and lump sum, Chetra? Absolutely, right? So let's say the best way to think of this is you have salary coming every month, but you have bonus coming once a year. So whenever you have salaries coming, you start investing into SIP every month, and whenever you have lump sum, you invest the lump sum once and for all. Yeah. Nishant, in that case, would it be beneficial if we buy dividend fund where the NAV grows as well as dividends can be used to reinvest? So Nishant, good question. In the dividend fund, the dividend actually gets credited to your bank account, right? There is also a dividend reinvestment fund, but let me try and explain, right? So the growth fund, whatever dividends are coming in, the dividends actually get reinvested and your NAV increases, right? Your NAV increases in your growth fund. So unless you are not expecting to get some money credited into your bank account every month, you should go the growth fund route, right? And if you are expecting some money to be credited into your bank account, only then go for the dividend, right? Gautam, do you want to add what is the difference between a dividend reinvestment and a growth fund? Maybe if you can, Gautam or Nishan.
Yes, Akshat. So Nishant, you need to understand, how this dividend payout option works. So basically, what happens is, from the returns, right, what a fund or scheme has, generated. So the dividend is paid out from those, returns only, right? So whenever a mutual fund scheme announces dividend, right? So whatever the return a fund or a scheme has generated, you get return dividend from those returns only, right? So it impacts NAV actually, right? So that's why you will see, the NAV of a growth scheme, right, will be higher than the dividend option. So if you need and more importantly, if you get take the dividend out and then reinvest it, so dividend will be taxed, right? So if you don't need money, right, so it is a better option to remain invested in growth as compared to dividend option.
Perfect. And I think last question is LIC and ULIPs are also offering 13 to 15% returns as they're mentioned, but not sure average 10%. We can take this conversation offline as well. Happy to share more details. You can put this in the group. But see, let me put it in this way, right? If I am putting 100 rupees in a mutual fund and putting 100 rupees in a ULIP, since it also has a a life insurance cover, maybe 4 to 5 rupees will get cut for that, and only 95 rupees get invested into the mutual fund, into the scheme. Actually, the remaining for 5 rupees you are getting that 10 lakh, 12, 15 lakh rupee cover, so on and so forth. Whereas in a mutual fund, if I'm putting in 100 rupees, even if 1% expense ratio is getting cut, my 99 rupees are getting invested, right? Now think of this when you increase the amounts and when you continuously invest every month, right? So you are unnecessarily paying more charges for a ULIP as compared to a mutual fund, correct? And therefore, it is suggested that when you're investing for the long term, mutual fund is a better way to go as compared to you, right? I have a term insurance as well, very good. Access my life, max life yearly 1,20,000 after 20 years, 1 crore rupees. They're saying no, I didn't get that. So, but then that is not term insurance. 1,20,000 is a very big amount. If you act, you can you will get 10. If it's actually a term insurance, you will just get it for 10,000 rupees. 10,000 to 15,000 rupees a year is more than enough. I mean, is the maximum. I once again, I'll just suggest just get on on a call with a team with Ethica, and they'll be more than happy to give you all the answers there.
Yeah.
Any other questions? Now the market is down. Is it good to invest lump sum in mutual funds? Uh, Good question. So there is also something called as STP, Systematic Transfer Plan. Okay, study about it. You can even watch the video. Now, what does STP in such conditions, right? What is the best way is you put your mutual fund, you put your lump sum amount into a debt fund, right? A debt fund or a short-term fund. Remember debt funds? Now, STP means moving from debt fund to from a debt fund to a equity fund systematic transfer plan, correct? So what you can do is, let's say you have 1 lakh rupees, put it into a debt fund, set up an STP. So what will happen is every month, and you can choose the frequency. So every week, every 15 days, every month, you can choose some amount that goes invested into your, your equity side, right? So from 1,10,000, maybe every 1 week will get. And as Mesjan also shared in the slides, right? Don't put all your money at once. Put that rule, right? 1/5 of the market crash. So as soon as the market crashes, put 1/5 of your money into that, and then once again, if the market crashes, put 1/5. So long answer short, don't put all your lump sum at once. Just invest it into multiple intervals, so that even if the market goes further down, you still have some cash left with you. Great. Thanks much. Happy to be part of the session. So are we. Very, very happy. Viraj has some experiences with LIC. Okay. Okay. No worries. Yeah, true. But yeah, that's a subject, that's a topic for altogether a different discussion. But yeah, happy to, come back and do another session on that. Uh, But I hope this answers. My company has been closed due to certain change. So which is better mutual fund to invest? Huh? Which company? Mutual fund company got shut. Now that there is an option of 100% equity in NPS, mutual funds are still better. Nishant, yes, I'll tell you why. In NPS, you can't withdraw your money till you are 60, right? You can now withdraw up to 80%, but the remaining 20% will go into annuity. Again, I'm not saying you should not invest in NPS. If you are in the old tax regime and it is giving you a benefit, you can invest in NPS. But again, there is mutual funds is a must have, right? Mutual funds is a must have. NPS, ULIP, and all these other schemes then become should have or would have types, right? But mutual funds is a must have because it's very flexible. It's very flexible. Today you put in money, tomorrow you can take out money. If you're not liking that the mutual fund, as Mizjan suggested, you can actually withdraw money from one, put it into other. You have more options of selecting index versus active versus large, mid, small, so on and so forth. So the flexibility is a lot more. Growth versus regular fund, does switching really help after certain period of time, say 5 years, and then reinvest? Since I see my app asking me to switch to regular funds. No, Vasumati, you're doing the wrong comparison. It will either be growth versus dividend or direct versus regular. So regular direct fund is a fund. Okay, so when you invest via an advisor or an agent, you are usually investing into in the regular mode. And what this means is uh, the agent that is helping you invest your money, the advisor that is helping you invest your money, actually gets a commission from the mutual fund company, right? In order to help you to cover their advisory costs, right? And that's where you have the regular fund route. The direct fund is you investing directly into the mutual fund scheme through the AMC, which is the DIY investor, right? So all these apps, Grow, Zerodha, ET Money, so on and so forth, all of these apps, they are actually helping you invest in the direct route, right? So the question that you have to ask is direct versus regular. Now, if you have an advisor that is helping you, is a trusted advisor, gives you quarterly analysis, so on and so forth, and you can't do things on your own, you still need somebody to work with, then going the regular route could make sense for you. But if you're doing everything on your own, you're doing your own research, you're doing your own analysis, investing on your own, then going the direct route makes sense because you obviously save some commissions there. How much I invest for better return, please? Abhay, again, wrong question, right? Go check that calculator. Now you have the Mission 1 CR calculator, right? Go put the amount 1 crore, 50 lakhs, 10 lakhs, whatever is your target corpus, and see how much you're able to get. How much I invest for better return? If you invest 10,000, you get 10% return, you'll get 1,000 rupees. If you invest 100 rupees, you get 10%, you'll get 10 rupees. So question has to be, the question of how much the return will be the same, right? How much you can invest will come from how much you earn and, how your salary will work. As only vice versa, we have less balance in account. Okay, I got your question now. Okay, now I got your question away. So you're saying that the company that you were working for got shut down and currently you only have your wife working. Now that makes sense. Okay, so yes, so I think what you should do is you should jointly look at your finances together. What is your family income? Together, what is your home income? And based on that, see, it's now even more important for you to invest so that you're dependent on one salary, right? So therefore, you should jointly look at it. Whatever be the amount, I would suggest try to see if at least 20% amount can be saved, right? But most important, you need to have an emergency fund. It's very important to have an emergency fund because since you said that you only have one earning member right now, that emergency fund has to really help you over we have less balance account. That's not good, right? That's not good. You should have some balance in account because again, you have to make sure that your life continues, right? You have to pay the bills, you have to pay the rent, so on and so forth. I hope that helps away. But yes, as I said, please feel free to reach out to me. We'll also share although our phone numbers are there on the group, and we are very approachable, happy to answer anyone's questions. But I'll also share mine and Mizjan's LinkedIn profiles in case somebody wants to connect with us and, kind of just have some discussions. We're more than happy to do that, right? I'll just put both of our profiles. Where do we get the recorded session? Ankit, maybe you can guide.
Yeah, so it will be uploaded on YouTube channel, and also you can get it on Monday 11:20 p.m. on your email via Zoom webinar. So it will be there.
2025 was the year of small cap, but not in 2026, negative in 20. Next approach have stopped the SIP. Should the next approach be STP to a different fund? No, Virat, see, you're thinking of it the wrong way. Question is, when do you need the money? Do you need the money 10 years from now? Do you need the money 3 years from now? Do you need the money 5 years from now? Based on that is when you will be able to, based on that, you will be able to get some understanding, right? So 20 years from now, continue with the small cap investments. Just check whether your small cap fund is beating the benchmark or not, right? Remember, we showed you that advisor coach example. Just check. If it is continuously beating the benchmark, you don't have to worry about shifting it, right? Always small cap gives great returns, but it gives great returns when you're consistently invested in it for a long period of time, right? So don't change your approach based on the market condition or based on what the fund has been performing over the last 1 year or 2 years, especially small caps. Small caps will give you returns only for more than 5, 7, 10 years of consistently investing. Not even 5, I mean 10 and above.
Yeah.
Thank you, Mizan. Thank you, Ankit.
Thank you.
Thank you,
Thanks,
everyone.
Thank you so much, sir.
Thank you so much. Yep, we will continue meeting you all at the WhatsApp group.
Yeah.